Is the US stock market about to crash? Well, let me share with you three signs that the US stock market is overvalued and likely to crash soon. Now, this video is not meant to scare you, so I'm making this so you can plan accordingly because market crashes create buying opportunities, just like what happened last year. Now, if you missed last year because you're new to the market, at least now you know it's important to watch the market closely. Now, the good news is you don't have to guess. Now, I will share resources that can help you monitor these signs. If it's your first time here, welcome to the Dealmaker channel, where I talk about investing in multiple asset classes such as stocks and real estate. So my goal is to share my research and my lessons learned so you can become a better deal maker in any market. Now, if that's something that resonates with you, consider subscribing to the channel. Now let's get going. Is it important to know if the market is going to crash or not? Well, for most people, it's not important because if you follow a dollar cost averaging or a peso cost averaging strategy where you invest a specific amount of money month in, month out, whether the market is up or whether the market is down, then you don't need to know if the market is going to crash or not. But for some of you who are maybe like me, who want to be able to buy more, in the event that something like this happens, then it's important for us to monitor the market, know where it's going, and are there buying opportunities. Plus, there is actually a way to profit even if the market is going down. Because normally, there are two ways that people make money in the stock market, right? Number one, you buy a stock when it's low and then you sell when it's high. That's one way of making money in the market. Now, the second way is you buy a dividend stock, which is why I've been covering some dividend stocks in the past. So when you buy a dividend stock, it's going to give you a dividend whether the market is up or whether the market is down. But there's also another way to profit from a stock market crash, and I will share that with you, later if you stay on with me in this video. But first, what we need to know is the market about to crash? When will it happen? Or what are the signs that the market is about to crash? So I'm going to share with you a website. So let me share my screen with you. So this is the resource that I wanted to share with you, currentmarketvaluation.com. They run 5 statistical models to see if the market is undervalued, fairly valued, or overvalued. And right now, 3 out of the 5 models show that the market is overvalued. As of July 16, it says that the S&P 500 is overvalued. If you don't know, the S&P 500 is the main index of the US stock market. It has actually replaced the Dow Jones as the main indicator or the main index of the US stock market. So we're going to look at 3 of the 5 models that say that the market is overvalued, starting with the S&P 500 mean reversion model. So mean reversion simply means that what goes up must come down. So it's a concept in statistical analysis where if you have a set of data, it will have an average. And over time, if something is higher than the average, mean reversion means that over time that thing will go down to the average. And if it's way below the average, then over time it's going to come up to the average. So that is what mean reversion means. And that's how the stock market works. Now, sometimes it's overvalued, it must come down. Sometimes it's undervalued, then it has an opportunity to go back up. So according to this model, the S&P 500 is 82% above the modern era trend line. So you can see here, so in this figure 1, so you can see the trend line. This is the dashed line over here. That is the mean, or that's the average trend line of the S&P 500. And this is where we are right now. As of July 16, 2021, the value of the S&P 500 is 4,327, and it is 82% above the modern era trend line. So you can see here that the market can go up. Like here in the 1950s, it was below the trend line, and then sometime around the mid of the 50s, maybe 1955, it started to go up. So it stayed above the trend line, and then on 1970s, probably this is 74, 75, it went down the average of the, or it went down that average trend line, and then went back up again towards the end of 2000. Then this was the highest point of the dot com, no, dot com mania, and then it went back down, recovered, and then after the 2007 crisis, it went back down again. And since 2010, this market has been going up, and even during the crash last year, during the pandemic, right, it was above the trend line, right? It was above the mean trend line. So the market, according to this model, right, the market is ripe for a correction or a crash. So that's very important to think about. Okay. We can also look at that in a little bit different way to kind of compare, because in the previous figure, we can't really compare it in we can't really compare it against the 2000 year 2000 internet bubble. But in here, we can see clearly that the internet bubble was also about 82% above that trend line, that above the mean. And today, last July 16, 2021, it was also at 82% above the trend line. So the market is at its highest level under the statistical model, comparable to the internet bubble of the year 2000. So we have one model down saying that the market is overvalued. So let's go to the next one. The next model that we will look at is the Buffett indicator. This was a measure or a metric that was proposed by Warren Buffett during an interview many, many years ago. Now, he says that it is one of the best indicators of where valuations are at the moment. And right now, the market is strongly overvalued according to this indicator. The Buffett indicator is the ratio of the total United States stock market valuation to the total GDP of the United States. So this is how it's computed. Right now, the aggregate US market value is $53.6 trillion, and the annualized GDP is $22.9 trillion. So according to the Buffett indicator, it's 234% or 88% above the historical average, suggesting that the market is strongly overvalued. So this is a historical all-time high. All right, so according to this chart, the middle black line, that is the mean trend line. So that is the fairly valued of Buffett indicator value. Today, we are at 88%, right? 88% above the mean. During the internet bubble of the year 2000, the market was 67% above the mean. And then during the crash of 2009, it was at 48% below. It was at 48% during the financial crisis. According to this indicator, we are at a strongly overvalued market. So let's look at the third one. So the third model that shows the US stock market is strongly overvalued is the price to earnings ratio of the market. So currently, the S&P 500's 10-year PE ratio is at 37.3, and this is 90% above the market average of 19.6. So this suggests that the market is strongly overvalued. So we can see that in this chart right here. So during the internet bubble of 2000, the ratio was 132% above the historical average. Now it's at 90% above average. And as you can see, during the internet bubble era, that number kept climbing. Okay, it kept climbing through the years or through the months of the US market, similar to what we are seeing now. So it's actually quite possible that even though the market is overvalued, it can still go up. So no one really knows when the crash will happen. So remember that although these three models show that the stock market is overvalued, they don't cause the stock market to crash, right? They just measure the data and then they're just showing that the market is really overvalued right now. So again, important, they don't cause the stock market crash. There are other things that can cause the market to go down in value. So like we had the pandemic last year, or it could be a trend of corporate earnings going down, or it could be the Fed raising interest rates to higher levels and thus making stocks, which are risky assets, to be less desirable compared to, say, bonds, which are guaranteed assets or safer assets. And like I said earlier, I'm going to show you how you can possibly profit in case the market starts to go down. Let's go back to my computer. Right, so we're here at Yahoo Finance, and this is a chart of VOO. If you remember, in one of my ETF videos, VOO is the Vanguard S&P 500 ETF. So this tracks the S&P 500. This is the blue line up here. Then the red line is another ETF called SQQQ. So SQQQ actually shorts the QQQ. Okay? It is an inverse ETF. So it's a tool that you can use to protect yourself, during a market crash, or to profit, during a market crash. So these inverse ETFs do the opposite, because normally to profit from a crash, you would try to short the instrument, so short the stock, short the ETF. But if shorting is not available for you, like for example, in GoTrade, shorting is not yet available, or you don't know or you don't want to short because shorting can be very dangerous. If it goes against you, the downside or the risk is unlimited, unlike a stock. So with a stock, when you buy a stock, the downside is just zero. Your whatever you invest, now you can lose everything. But with a short, now you can lose more than you put in, when you short something. So the way to get around that is to buy an inverse ETF, so like SQQQ. So SQQQ shorts the QQQ, so it runs opposite to QQQ. Looking here, so as you can see here, during the crash last year of 2000, you can see here that as the S&P 500 went down, QQQ started, or SQQQ started to move up. Okay, so and then it started to go down again when the S&P 500 started to recover. So this inverse ETF is not a long-term holding. Okay, so it operates just as a hedge against a market crash. So it is one way that you can use to protect your portfolio from losing too much, by maybe allocating some of your cash, to an inverse ETF like this one. So that's why it's important. For this particular case, it's very important to time the market, because as you notice, it actually goes down in a bull market. When the market is going up, this ETF is actually going down. So it runs opposite. So the best time to buy this is during a crash, preferably during the early stages of a crash. And once you can see that the market has recovered, then you can already sell this inverse ETF already. It has already done its duty. It's giving you a profit and acts as sort of a protection for your portfolio during a market downturn, especially if the downturn lasts for a long time. So let me quickly summarize what we have just discussed in this video. But before I do that, please make sure to hit the like button, especially if you like this video. That really helps the channel and it supports me. It helps the channel grow, and I really, really appreciate it. Thank you for your support. Thank you for watching all the way until the end. So what we have learned is that there are three signs that the market is overvalued. So there's the mean reversion model, there's the Buffett indicator, and the PE ratios, the average PE ratio of the S&P 500. They're all at levels that were last seen during the 2000 internet crash, during the bubble of the year 2000. So we are in bubble territory, but the bubbles are still likely to melt up or to continue going up. So there's really no indication, there's no model yet that predicts when a market crash happens. So it's very important that you watch the market. And that's what I'm doing. Now, I'm watching the market, and hopefully I can let you know when the signs are there that the crash is already happening. So I hope that you subscribe to the channel, and I'm curious, what did you learn from this video? More importantly, what will you do if a market crash happens? Right? Will you continue buying stocks? Or will you continue buying dividend stocks? Right? Because that's a great idea. If you buy dividend stocks of good companies that can survive a market downturn, you will still get income, even if the market is going down. Or will you buy an inverse ETF like SQQQ? So please let me know in the comment section below. I'm curious to hear what you will do in case that happens. If you want to have more ideas on the stock market, check out my free stock analysis video here and my free stock investing course for beginners. Always remember, it's always a great day to make deals, and may all of your deals push through. See you in the next video.